What's up, everybody, and Merry Christmas, Happy Holidays. Hope you're doing well. Chad Anderson, Zach Jones, More Than Mortgage, episode 54. I'm going to start doing it. I did it last week. I kind of like this whole season 2, episode 2 type thing we got going now. All right, so property taxes. That's our topic for today. It's a little bit different state to state. It's kind of hard to keep up with sometimes because it's all about when it gets assessed. And then there are certain things that could trigger assessments, such as a sale, maybe even a refinance, maybe a new neighborhood going up nearby or something like that. Some states, you have the homestead versus the non-homestead exemptions, and that can make your taxes either, a normal as if it's a primary home or even a secondary home, or if it's an investment property to make investors pay a little bit more tax than somebody who's living there. So all kinds of different nuances, ins and outs. But Zach, this is a topic you actually brought up. We'll let you start to run with it. But this is the time of year all those bills start coming out. People start getting caught up. Your escrow accounts kind of get shuffled around a little bit with lenders. Mortgage people are going to start getting phone calls. Why'd my bill go up? Well, we didn't increase your bill. Your county did.
Right.
Those kinds of things start happening, right?
So maybe if we go from kind of maybe the worst case scenario for the most aggressive tax structures that we know of in the United States to the best or the cheapest for the consumer. I got a philosophical problem with property taxes, but we're not going to go into that. So the worst case scenario is counties and I don't know if that's all county driven. It feels like there's this maybe a state overlay where all the counties in a particular state do things a certain way. The kind of worst situations that I see are counties that have a reassessment of value every time a property transacts, meaning changes hands. So let's say that you bought a house for $250,000 15 years ago, and now it's worth $1 million. That house, when it sells, you may be making taxes or paying taxes on the house based on some variance of that $250,000 value. Maybe they bump it up a little bit every few years. But when the house sells, there's a new value attached to it in public records. And that now it's taxed at $1 million, and the new buyer does not, in effect, inherit your tax value in the new house. They have a whole new tax value, so that the taxes launch from maybe $300,000 or $350,000 all the way up to $1 million. So they have a much higher tax liability. The purpose of that at the county level, more revenue. They're just going to collect more revenue. So there's that's kind of one of the situations where you've got a really aggressive tax structure where the county is trying to generate as much revenue as possible. The other one may be an annual reassessment of value that is attempting to keep up with market values. So they do this kind of universal assessment. They're always going to be a little bit lower, at least, than real market values. But they go around and they just apply, hey, this year we had another, let's say that the market appreciated 6%. So the tax assessor's office adds 4% to everybody's value, and you get a new tax bill reflecting that higher value. So again, generating more revenue, even though the tax millage amount or the tax percentage stays the same, it's a higher value. So your property taxes went up.
Yeah. It's interesting, like I said, and it's different by state, sometimes by county, how these things shuffle around. Also in Tennessee, you have to be aware of the city tax because
some cities have taxes.
Yeah, it's not always just the county. Sometimes you have city tax, and then sometimes you have the green belt. And then in states like Alabama and Florida, you have homestead versus non-homestead, which in Alabama literally is a difference of double. If you're an investor with non-homestead, it's really double. And I know there's a small variance that you get in there as well, like $50 or something. But for the sake of simple numbers, it's either, homestead, meaning you're going to live there, or it's a second home. Second homes actually can be homestead in Alabama, or you pay the double tax rate, which is for investors are classified as H2.
So you're actually saying that if I had a $3,000 in Orange Beach, if I had a $3,000 tax bill in Orange Beach on an investment property that I was doing Airbnb on, if I lived in it, it'd be $3,000. But if I'm Airbnb-ing it, renting it out short term, it'd be $6,000.
Yeah. Now, again, in Alabama, if you have a second home, you can claim that as your homestead. So, for example, if you lived in California and bought a beach place in Alabama as a second home, you actually could use that for a homestead exemption as a second home. Now, does the county dive deep enough to figure out that they saw your listing on Airbnb and then cross-reference that with your tax bill and look and go, oh, well, this is coded for a homestead exemption, but I see it on Airbnb right here. Hi, Mr. Jones. How often are you actually in this property? And all of a sudden, you open up a can of worms. I don't know that for sure. Like I said, I didn't dive that deep on it, but it is something just to keep in mind. So all those things, and then the different tax bills take place at slightly different times. So, for example, in Alabama, they come out on the 1st. They're due by the 31st. In Tennessee, October 1st, due by December 31st. Alabama or Tennessee, it's October 1st. It's technically not late until after February 28th of the following calendar year. So you get a little more grace. Florida, I believe Florida actually lets you go until March 31st of the following year.
Maybe.
It's close. But then Florida also has it where if you don't pay the tax bill for some reason, you see it at the bottom of the bill. I just happened to notice it for one of our Airbnbs that you basically pay like a 1.5% interest or something crazy small to kick the can down the road if you wanted to. Yeah. So if you're not escrowed and you kick the can down the road, then there is something. I just see it at the bottom where it lists every month and then how much you owe every month as it progresses. So interesting things there about the property tax. One of the biggest ones that catches people, let me know if you want to explain this or I can run through it. And there's two things left. It's this and then the mortgage topic real quick. New construction always throws everyone off. Do you want to do a 30-second crash course on it?
Well, I was going to cover that in the best case scenario.
Okay. All right.
Because we did the worst case where they're really gigging you every year, every time the property transfers. In Tennessee, I believe that we have one of the best property value assessment systems for tax purposes. So that's a tax assessment in the country because we do not assess every year. And we also do not bump values up when a house sells. So effectively, if I have a tax assessed value on a house that I'm selling and that's $375,000, then the people who buy my house get to inherit that $375,000 value, even though I might sell the house for $1 million. So the older a house gets in the Tennessee system by county, the more the tax assessed value lags behind the actual market value. And that's a really nice feature. It just doesn't kick up every time and reset every time that the house is transacted or changes ownership. Over on the other side of this, the taxes do increase over time because Tennessee by county either reassesses that value every 4 years, or there are counties in Tennessee who reassess every 6 years. And they're always there's a code, a provision in the Tennessee code that allows for emergency reassessments. I've only seen one of those in my life of ownership of a real estate. Happened in the middle of COVID, was grossly unpopular. So it really is a kind of a nice feature in that every 4 years we will see an increase in value, but it never ever comes up to the value of the house. So in Tennessee, the shush code is, hey, I saw your tax assessment came in at $274,000. Don't tell anybody. Just take it and go. I know your house is worth $785,000. So that's great. The only exception to that is what Chad referenced, is in new construction. So in a new construction property, there's no value attached to that property as an improved piece of land. There might have a little $300 a year tax on the quarter acre or half acre lot, but that's a raw land tax. So it's not assessed on the improved or built on value of that property, meaning it has a house on it. So when a home sells for the very first time, the builders just built the house, new $500,000 house, your tax assessment will be $500,000. It'll be based on that sales price. So that's the only time, at least in the state of Tennessee and maybe other states that do things similar to us, the only time that a tax assessed value will be equal to the market value is when the house is brand new. And then it begins to lag behind the actual market value of the house through the life of the house. Is that pretty good explanation?
Oh, fantastic. And that is one of the beauties of it is you buy a certain house, especially too, people right now who are buying post-COVID in Tennessee. Some of you are benefiting from that old value because we all know how crazy things got from 2020 to present day. Even though it's cooled off some, it's still significantly up compared to when COVID started in February of 2020 here in the Southeast, or March of 2020. Last thing is on the mortgage side, and that is your escrow review or your escrow analysis. So first off, let me throw this disclaimer out there. If you get a property tax bill in the mail, but you pay your property taxes through your mortgage, it's included in your mortgage payment. On that bill, I guarantee you it says this is for informational purposes only, or this is a notification, because they'd send you the bill and say, hey, here is what your property taxes are. But if you pay through your mortgage company, no need to call your mortgage company to tell them to pay it. They're getting the same bill. They're going to make the payment for you, I promise. Because you have to think about it from the mortgage company's perspective. They have a lien on your house. Well, if the taxes don't get paid, all of a sudden that can interfere with their lien and the county can come in. So the mortgage company wants taxes and insurance to be paid, but especially, well, really both, because insurance obviously protects their investment, but taxes they want paid. They don't want to leave it up to the county to come in and start doing a tax foreclosure, God forbid, or anything crazy like that. But the other is what Zach was saying on the worst case scenario is if the payment goes up, let's say the assessment goes up, therefore the tax bill goes up, therefore your payment on property taxes go up. Well, if you pay it through your mortgage, obviously if you keep paying the same amount, then when the bill comes due at the end of the next year, you're not going to have enough in that account in order to pay the bill. You're just simply not. So that's the best way I can explain it, is if you just try to think like, okay, my bill went up. Well, if my mortgage payment doesn't go up and it's not your note, your loan payment, it's the escrow portion of your mortgage payment. If you don't increase that, you're going to be short at the end of next year. So that's why those things go up, and they have what's called an escrow analysis or an escrow review. And they start coming out around January, February of every year, because the tax bills have gone out and their reassessments are being done on the properties that mortgage companies are holding. So if you see that, I understand it sucks. There's nothing worse than going through holiday spending, stress, and let's be honest, family, and then getting to the new year. And within the first 6 weeks of the new year, you get a bill that says, oh, by the way, there's not enough money here. So we're going to need to increase your payment by 100 or 200 or whatever the math is to make sure there's enough on the backside next year when the bill comes due. So anything I left out with that? I know you're excited about these phone calls coming up.
Yeah, it just happens every year. I tell people up front, though, when we're originating the loan, here's your principal and interest payment. Right. It's not going to change. It'll be the very same until you make your very last payment, and then it'll be up $17 or down $17. However, we all agree that we can count on the fact that taxes, insurance are going to creep up because that's what they do. So that's where those reconciliations come in. I was just kind of curious about going back to the new construction versus and the lagging value. I looked up my tax value. My tax assessed value is less than half of the actual market value of my house right now, and my house is 6 years old. So that's Tennessee life for you.
I think the county just said we're not going to assess past 2 million, Zach. I think that's what they said.
big time, right?
Yeah,
big captain.
You and your much fancier bookshelves than mine. Notice Zach has all those file folders of customers who actually use his services, whereas mine's a baseball bat.
Yeah,
Like,
you're watching sports reruns on NFL Classic all day, aren't you? Yeah. While I'm over here slaving.
I have to keep Nick Saban quotes behind me in order to stay motivated during the day. That's what I do. Yeah.
Over your
all right. Any final thought before we wrap this one up?
No, we're good. That's a good wrap on property taxes, because there are very specific advantages depending on where you live to how those taxes are assessed.
Yeah, 100%. And as always, guys, don't trust the internet. If you've got questions, Zach and I aren't here to like push you or shove you or try to sell you on something. If you just got a question, we honestly love answering, educating, helping, whatever you want to call it. So all the socials are up here. Zach Jones Loans, Mortgage Dad Chad. Subscribe, like, download, hit the bell, do all those things. Comment, DM, reach out to us. We're good to help or just answer questions or whatever kind of banter you need in order to feel comfortable about your situation. So, all right, that's 54 of them in the books. Hope everyone is having a fantastic holiday season as we wrap up the end of the year. And we'll be back next week. We're going to talk about homeowners insurance, because that goes hand in hand right here with the property taxes. So we're going to dive into that as well. It'll be part of the escrow analysis. And we'll look at it from all angles and some different things. And why is it going up so freaking much in the last year or two? It's brutal right now, but we'll talk about all that. Hope you have a great week off, whatever the case may be. And we'll catch you next week on the channel. Take care.
See you next time.